Welcome to Tech Talk Tuesday. We are recording a day early this week. It's Monday, September 25th, 2023. I'm your guest host, Karla, and with me today is your favorite CMT, David Blake. David, how are you doing today?
I'm doing well, Karla. Thank you.
Great. Well, let's take a jump right into it by taking a look at last week's activity and what's ahead.
Okay, well, last week we had a pretty rough week in the market. I think investors were pretty cautious ahead of the FOMC announcement on Wednesday, but it wasn't so much that they knew rates were going to be unchanged. I think that the inflation data that we saw for August had people a little bit on edge as whether the Federal Reserve was going to be a little more hawkish in their statement, and that's kind of what we got. Again, we're looking at the longer or higher for longer type of a deal. And after that statement, we saw rates begin to tick higher again. In fact, on Friday, we actually got almost, I think, to 4.5. Then we ended the week at 4.43. The 2-year was as high as 5.15 and ended at 5.09. You know, we've been talking about the resistance levels for the yields being at that. If we got above 4.5, we probably would see the market struggle. So anyway, so the Federal Reserve's hawkish pause that we got on Wednesday, it sent equities pretty sharply lower. Those losses accelerated again on Thursday, and we saw the major averages fall below their key moving average support levels, which we've been keeping an eye on. Also picked up a lot of analysts reporting that consumer spending stocks, because of the higher rates, were beginning to get hit hard. And by that, I'm talking about the restaurants, casinos, housing stocks were, again, one of the weakest industry groups. Part of that's because we saw the yields on the 30, I think, up to around 7.3 or something like that. So that, of course, is kind of hitting the, all the consumer spending stocks. You even saw stocks like Dollar General, Costco, Target, those type of stocks begin to pull back. And today, I'm actually hearing that some analysts are beginning to lower Christmas season numbers too, because they're expecting these higher rates to start to, as they kick in here, and we're starting to see debt levels rise, that people will maybe spending a little bit less over the holidays than originally anticipated. Okay, the consumer discretionary and REITs sector led the market lower last week. They were both down more than 4.5%. We also had pretty heavy selling in materials and financial. The banks, of course, as the rates go higher, sometimes you think that that's going to be better, for the spread for the banks to make money, but they have to start. They have so many regulations that they also have to put away loan loss provisions, which is going to hurt them. In fact, the Regional Bank ETF with the symbol KRE was down 5.8% last week. So it's definitely feeling the pressure of this consumer starting to slow down. Okay, one pocket of strength was crude oil prices, and they're bouncing around up over 90. Today we saw a little bit of a pullback. They're still trying to hug that $90 a barrel. We'll see how long that goes, but most people, because of OPEC plus production cuts, they're intended at this point to stay through the end of the year. That $90 a barrel is probably going to hold for a while. We also saw the U.S. dollar nudge higher, and it's higher now for a 10th consecutive week. You don't hear a lot of people talking about that. That's not real good for equities going forward. You'd like to see a smaller, weaker dollar, and in fact, as some of these international companies begin to report for the third quarter, as they transform over to from euros into dollars and all, that's going to weigh on their some of their revenues and profits. So we'll keep an eye on that. That may start to affect the strong dollar may start to affect some of these international companies, or it will affect some of their earnings. So anyway, after the 3 days of heavy losses last week, we saw a little bit of a bounce on Friday, but it faded into the close. Part of that, I think, is they want to see what rates are going to continue to do, and then of course we have the government shutdown looming over our heads at this point, which shouldn't have much of an effect on the market. It never does. It's happened before. If it does, sometimes it'll pull back and then retrace that pullback quickly. But we were down for a third week on the S&P 500 and NASDAQ, and the Dow Jones was lower for a second week over the last three. The technical condition of the market did deteriorate again last week. We saw the major averages sharply lower as rates soared. And we saw the moving average support levels violated again. They all broke below their 100-day moving average, which we've been careful to watch. And we actually had the small cap Russell 2000 drop below its 200-day moving average. And that was the first time that that's happened since early June, before we started this summer rally. So that's another red flag going forward here. Technical indicators for the different indexes are now in bearish territory. We saw momentum as measured by the 14-day RSI negative, and it means momentum has slowed. Another thing that I watch, Connie Brown is a technical analyst here, actually from Atlanta. She's noted that when you've been in a kind of an uptrend and you see the 14-day RSI break below 40, that's kind of an indication that a longer term trend is ending, and we're starting to change directions on that. If you start to see the 14-day RSI dipping down here at 35 and stuff, you can probably expect that this selling will probably go on a little bit longer. And on the upside, she notes that when you've been in a down market, if you can see the 14-day RSI get up to 70, that usually means that now we're starting to see a reversal of the downtrend. But keep an eye on the 14-day RSI when you look at the charts, see if it's going to stay there. Perhaps it was just a 1 or 2 day thing and we flip back up above it. I'm not sure that's going to be the case, but you can keep an eye on that. And we also watched last week, we saw the Dow Jones recorded a bearish head and shoulders pattern. The S&P 500 and NASDAQ, some are saying they've already broken that. I think it's a little bit more tentative. But with the Dow, if you do the measuring from the head to the neckline, that's going to give you a target somewhere around 32,750, 32,800. That's a downside target for the blue chips. We'll see how that goes. Perhaps this week we'll get a definite violation on the S&P and NASDAQ of a head and shoulders patterns. But without that, I'm looking at the S&P 500 for the price target somewhere around 4190 to 4200. That would coincide with their 200-day moving average at 4190 on Friday. And then a downside target for the NASDAQ would be 12680, 12700. And then below that is its 200-day moving average, which I'm not sure it'll get to, but that would bring in 12469. But I think probably that 12680, 12700 on the NASDAQ would probably serve as support. Now, the secondary indexes, which include the Dow Jones Transports, Russell 2000, and Philadelphia Semiconductor, I kind of group those together to see whether they're going to lead the market higher or lower. Unfortunately, they all are underperforming the big three. And in fact, one point that I brought up on Friday was that all three of those indexes are deeply oversold. Stochastics had reached into the single digits, and I thought that would lead to probably a short-lived bounce this week. As I look at the charts today, that actually the small cap Russell and the transports are having a pretty good session. So they are coming off that oversold level. I don't know what it's going to hold, how much it's going to hold for the transports. Part of that is because of FedEx's earnings that came out, and the stock had good support. But the other ones, again, are basically just they got, when you get to the single digit stochastics, you're overdue for a bounce, and that's what we got on those indexes today. Underlying breadth, it continues to be pretty weak here. The NYSE and NASDAQ, both of their advanced decline lines, which we look at as leading indicators, lost a lot of ground last week. The NYSE, the cumulative AD line, basically has retraced all of its gains that it had made since early June when the summer rally started. The NASDAQ is probably below that, but technical analysts don't put as much weight on the NASDAQ because you have a lot of garbage stocks in there that when the market starts to pull back, they all go down. But like I say, as the AD line keeps working its way lower, that's definitely a red flag for the major averages. Another thing we saw the number of new lows on the two indexes, again, outnumber the new highs by a wide margin, and it's expanding. We had 220 new lows on the NYSE last Thursday. That was the most since May. And then on the NASDAQ, they totaled 443 new lows on Thursday, and that was the most since April. Investor sentiment is neutral, but we did see a reduction in the bulls in both retail and the pros. So I think at this stage, the risk, like as I mentioned, was still to the downside. We didn't get the Fed was pretty neutral. They didn't raise rates, but they were a little bit more hawkish because of the inflation data that we got the first week of September that showed a little bit of an uptick, and they are pretty much not hedging the point that they are 100% behind inflation coming down to that 2% target. In fact, the Chicago Fed President Neil Kashkari today saying that the Federal Reserve is 100% behind that 2% rate. They are surprised at the strength in the consumer, although they are seeing signs that maybe we could be getting extended on the consumer spending going forward. But at that point, with I mentioned that as we start to see, kind of until we see rates kind of settle down. Today, we actually saw the rate on the 10-year Treasury go above 4.5%. And until you see these rates settle down, kind of firm up and where they and kind of go sideways, we're going to see some choppy trading, to say the least. So I would be just very cautious in here. I still think that we probably have a little bit more risk to the downside till we see the rates settle down.
So last week, the major averages turned in one of their worst weeks since March. You've also mentioned that perhaps we could see the market bounce since it was so oversold. Does that indicate or hint that we might be putting in a tradable bottom here?
Well, I do. I think that we're perhaps this week, with the government shutdown thing, that might cause a little bit more of a dip in the big averages. You have reached that oversold level in the secondary indexes. It doesn't mean they can't go down further. But like I just mentioned, you saw the 10-year Treasury yield pop above 4.5%. I've been writing for weeks that if we see that, it's going to weigh on equities. And today we were at 451. I don't know what it is as we speak right here. What we want to watch here over the next couple of days is to see, when you have a breakout, you want to make sure that it's a legitimate breakout. You don't want to have something, go 451. Tomorrow we go to 453, and then by Wednesday we're all the way back down to 440. And it was a head fake, and then equities start to rise. But you don't want to, until we see and get confirmation that, okay, we're above 450. Unfortunately, the next major resistance for yields on the 10-year is 5.25. We're above the October 22 high that we saw. So we're looking back now to October, November of 2007. I don't think we're going to get that high, but when you look at the charts, you have to be notable that this is the point in the past where rates went up to, and that was as far as they could go, and then we started to come back down. So we want to keep the eye on that to see whether this breakout is legitimate or whether it's just a head fake. Again, watch the yield for another 2 or 3 days. If we don't pull back under 4.5 to maybe at least a 440 rate, then we're probably going to see more weakness in the market. We do pull back maybe to 439, 440, then maybe we could get a little bit more of a bounce in the market. Our CTI, which is our cyclical trend index, which is our market forecasting measure, has worked quite well in the past, is close to several of the cycles, actually putting in a bottom here over the next, within the next week or two, maybe 3 weeks. As long as we keep making a newer low, the cycle extends itself. But it's also telling us that we perhaps could be due for a little bit of a bounce here sometime over the next 2 or 3 weeks. I'm not sure, how much of a bounce that's going to be. We'll have to wait and see how strong it is. Also, whether if in the next week or two we have like a sell off or blow off bottom, then that would probably give a bounce more emphasis on that, give it maybe a little bit stronger than what we're looking for currently. So right now, if you're a real active trader, you're watching here to see if we, get down here and we are able to do it, get it bounce off here the next week or so and start to high. Maybe you can buy something and get a trade out of it. For the longer term investor, if you may have some things that you want to nibble on to put in your portfolio for long term. But again, as we slow down, you don't want to go into the early cyclical sectors yet. And by that, I'm talking about consumer discretionary, technology, those type of sectors. They are what lead the market as we start to go into a recession, because those are where we're going to start to see the money go into, and they'll lead the economy out of a recession. But at this stage, while the energy sector and utilities are still leading, that again points to a late stage cycle for the economy. Utilities will start to roll over again as rates go higher, because why buy a utility without hardly any growth if you can get a treasury or something like that. But again, until we see the rates settle down here and firm up and show us for sure that we confirm that we've broken out to the upside on yields, or whether it was a head fake, I think you just stay cautious. Again, I talked a little bit about portfolio diversification last week. There's nothing wrong with having money in some of these fixed income stocks and treasuries and all, get some tax-free rates. If you had made 5 or 6% over the last 2 or 3 years, I think you're pretty happy with what you have in there. So let's just stay cautious, and again, keep your eye on that 10-year rate, because that's going to lead the market higher and lower.
All right. Well, that's a lot of great and helpful information. Is there anything else that you'd like to add in for this week, David?
No. One thing I have heard a lot of analysts saying, some say that oil is peaking here, and some say that it's going above 100. I don't know, but I do know that the oil companies are going to be making a lot more money again, over the next, probably for this second, third quarter, as they report earnings. I don't think, you may see some temporary pullbacks, minor pullback in something like a Chevron or Exxon, if you see oil come back down to 85 or something like that. But I think longer term, they're good for a while here. I would hold on to them, and not though I wouldn't listen to the analysts and say, okay, it's going to pull back, I need to get out now, because that's really one of the only things that's working right now. And you've got oil up about 27% over the last 6 weeks or something like that. So that would be my only thing. I wouldn't get too involved in the talking heads on TV and think about selling your energy stocks. I think they've got a little bit further to go.
All right. Well, that wraps up for this week. Nice and short and sweet, or not so sweet considering those downside targets. Thank you for listening to this week's Tech Talk Tuesday. As always, if you have any questions, or if you'd like us to cover a certain stock, you can go ahead and message us at this chat now box located on your lower right-hand screen. Thank you again, David, and we'll see you next week.
All right, Carl, have a good week.